How do central banks impact exchange rates? In today's financial climate, the role of central banks has become a hot topic. With recent shifts in global markets, many are asking how these institutions influence exchange rates. Understanding this can help you navigate your investments or even your travel plans. So, let's break it down. Central banks impact exchange rates primarily through monetary policy decisions. When a central bank raises interest rates, it often attracts foreign investors. This increase in demand for the currency can cause its value to rise. Conversely, if interest rates are lowered, the currency may lose value as it becomes less attractive to investors. Another tool central banks use is quantitative easing. This involves purchasing government bonds or other assets to increase the money supply. When more money circulates in the economy, it can lead to a depreciation of the currency. This is because each unit of currency may lose some of its value due to the increased supply. Forward guidance is another method central banks employ. By communicating future policy intentions, they can shape market expectations. This can influence investor behavior and impact the demand for a currency. For instance, if a central bank signals a future interest rate hike, it may boost the currency's value in anticipation. Central bank independence and transparency are also key factors. Research shows that when central banks operate without political interference, they tend to maintain more stable exchange rates. Transparency helps manage market expectations and can reduce volatility. Some central banks actively manage exchange rates by intervening in foreign exchange markets. They may buy or sell their own currency to influence its value. This action can stabilize the currency, manage inflation, or support economic growth. The nominal exchange rate also plays a role in inflation and unemployment. If a currency appreciates, it can make exports more expensive. This could lead to higher unemployment in sectors that rely on exports. On the flip side, a depreciation can boost exports but might increase import prices, potentially raising inflation. In summary, central banks utilize various tools and strategies to influence exchange rates. Their decisions can have far-reaching effects on economies and markets worldwide. Understanding these dynamics can provide clarity in an ever-changing financial landscape.